Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you so much for joining us on this December the 22nd Market Carver. We're going to keep it brief here. Got 3 points to cover with you. Some of the things we hit Monday in our investment allocation meeting. First, an asset class we don't talk a whole lot about, but closed-end funds. A couple of reasons why it's important to at least understand the structure and how they can lead people astray and sometimes offer opportunity. Andrew's going to break down mega caps and look at the trends on those stocks, which are so very important for the major indices. And then take a look at credit cards and the state of the American consumer. So let's start off with closed-end funds. So just a little bit of background. Buying a mutual fund, you got two different structures. By far, and I mean by way far, the bigger and well-known is an open-ended fund structure. This is mostly the mutual funds you're aware of, likely in a 401k or maybe how you invested before getting to FEG. But with the traditional open-ended mutual fund, the way it works is that the fund will always be priced at a level equal to what the underlying investments are worth. If they're worth $10, that's what you'll buy at, that's what you'll sell at. If more money piles into the fund will get bigger. If money comes out, the fund will get smaller. But all those trades happen at NAV, or net asset value. On the other hand, the other structure, much smaller in scale, but they are around and popular in certain corners of the market, is a closed-end fund. And it's just like the name suggests, it's closed. It issues a fixed number of shares at the very beginning. If more people want to pile in, the only way that clears is with a higher price. So just like an open-ended mutual fund, you know the net asset value, you know what the underlying investments are worth each and every day, but the price can go substantially above that NAV, and it can go substantially below. And that's what we're looking at here is one popular closed-end fund and the degree to which it trades around that net asset value. So just so we're all on the same page here, if it was at zero, that means that you're buying at exactly that fair value. If it's $10, that trade is happening at $10. Being above at 24%, that means the fund is priced at a 24% premium to what the underlying investments are worth. That can be a very dangerous game because eventually and inevitably this fund returns to net asset value. It may take a long time. It may take till the fund is completely depleted, but it does happen. On the flip side, we do constantly screen and look for opportunities where it's the opposite, where we can buy a fund that's worth $10 but maybe pay $8 or $7 as it returns to its value. The other thing that I'll warrant caution on is that closed-end funds are popular, notorious for their income. People will look at the rates coming out, and it's not uncommon to find something 10% or even 15%. The key note here to get across is that that is very rarely an actual income stream. That's very, very specifically the word we use is a distribution rate. That's because they're delivering not only income, but principal as well. All right, that can lead people astray. Think you're earning 10 or 15% when a good chunk of that is simply a return of your own money. So things obviously that we look at on your behalf, but if you're out there and you don't work with FEG, be aware of these things because they can really catch your eye and lure you into an investment that can be really destined to go to zero eventually. So that's closed-end fund market. Andrew, if you would tee up and talk about the mega caps and tell us how they've been doing.
Sure. We'll throw up the chart on the screen here for you. And we've seen when we look at the market, we try to divvy it up and look at to see from a risk tolerance perspective, are we starting to see the really big stocks, the mega cap stocks, think Apple, Amazon, Microsoft, are they what are leading the market higher or leading the market lower? Or are we starting to see those smaller stocks, small capitalization stocks, are they starting to show good relative strength? This gives us good insight into how aggressive investors are being. Typically, we see smaller cap stocks when they start to outperform. It's a good sign that investors are trying to be a little bit more risk on. Their risk appetite is improving. Where on the flip side, when we start seeing small caps underperform and those mega cap stocks, again, Apple, Amazon, Facebook, those types of stocks, when they're the ones that are leading higher, typically it's a little bit more defensive People are seeking shelter in these mega huge companies. So right now, what we're starting to see is this year has been not a great year for those mega cap stocks. They did really well last year. This year, they're being under more distribution. And as we start to see the market recover off those October lows, we saw the S&P 500, as you can see in the top panel here, get back above its 200-day moving average for a couple days. And we really saw a lot of good strength in the very bottom panel, the equal weight S&P 500, which equally weights across all of the 500 stocks, regardless of market cap, actually was showing a lot of really good strength. It was a good, encouraging sign. Whereas the FAANG stocks, the Facebook, Amazon, Apple, Microsoft, Google's, those mega cap names I was talking about earlier, they really continue to struggle. Now, as we see the market begin to roll over a little bit, we lost that key level of in the market, and both the equal weight and the S&P 500 fell below that 200-day moving average. Meanwhile, the mega cap stocks are almost back to their summer or late summer lows. A lot of stocks like Amazon, Tesla making 52-week lows. Microsoft, Apple also starting to struggle. We continue to see these really big, growthy tech, a lot of them are tech stocks or consumer sensitive stocks, really be under pressure after having such a blockbuster year last year. This has not been a great year for mega caps, which is why within our portfolios, we really have been trying to be very specific and almost surgical in the type of asset and allocation that we create and the exposures we take on.
Yeah, so very important, and it's just a remarkable how much that can make a difference if you can buy the 500 stocks and have them equally weighted, or 500 and weight them traditionally market cap. It's just been amazing to me over my career how different those return streams can be. So now one last point here, we're going to hit some economics here, and I'll have you discuss the credit cards and what we're seeing take place in the economy.
Yeah, so a topic that we've discussed kind of throughout the year, something we saw had potential to really gain the spotlight, was we started seeing the savings rates for consumers to come down. That often happens when we see a really good labor market. People get confident in their weekly or biweekly incomes, and they start drawing on their savings rate due to a strong labor market, and so they start spending. That's not a terrible sign that we start seeing a good amount of consumer spending. That helps bolster the economy. But what we started seeing in some of the data in November, and actually started seeing some of the increase in credit card debt earlier in the year, with a little bit of concerning nature. First, on the consumer retail sales figures in November, very much a disappointment. They started to turn lower, missed expectations, suggesting that maybe the consumer is a little bit under pressure, and they've spent a lot of the money they had saved as that savings rate went down. When we start then looking at where are they getting this money from that they are spending, looking at the credit card data, that type of spending has gone up. Revolving debt has gone up. And in fact, it's starting to go up faster than inflation. So the chart you're seeing on your screen now is looking at the difference between the credit card balances for U.S. consumers and the level of the consumer price index, the inflation rate. And so you can see on the far right-hand side, that red bar is that we're seeing a very large, not a very large, but a good increase in the level of credit card spending relative to inflation, one of the highest levels in several years. And so that is concerning. It's telling us that the consumer potentially is starting to really tap into a higher rate level of debt, as credit cards typically have, compared to just spending their weekly or biweekly incomes or from savings. And so if we do start seeing pressure on the labor market, the fact that consumers are already tapping into credit cards can be a nasty pair. Not something we're seeing yet. The labor market continues the current data we have to be strong, but we're starting to look ahead in 2023 and what are some of the potential issues the economy could deal with. And one very well could be consumer spending and potentially labor market issues, which is something the Fed has been pushing for, trying to get that labor market to cool off a little bit to help rein in the heightened inflation that we've had this year. So we're obviously looking into 2023. This is one topic that we'll be focusing on, watching how the consumer is able to handle this drop in spending and this increase in credit card usage.
Yeah, there's no doubt about it. We spent a good chunk of the middle of this part of the year debating whether or not we were in a recession. Probably we're not at this point in time. at least in the classic, official definition of the term. But that doesn't look to change next year. I think it's highly likely we're at least going to have this debate. It's very much on the table, and I think you highlighted one reason why that's at least a high degree of probability. Nobody knows. The economy can have a mind of its own. So we will certainly be on watch as we head into 2023 and factor that into the different types of sectors we want to be invested in. Very important part of that equation, even much more so than the direction of the overall market. So that's it for this week. We thank you so much. Wish you all a very Merry Christmas. I hope you all have a great time with your family. And lastly, don't forget to come in and see us. Call us at 800-928-4001. I'm sure as we flip the calendar to 2023, it'll be time to start scheduling your annual family update. And if we don't have the chance to work with you or haven't yet, turning to a new year and get past some of this busyness, give us a call and get on the book so we can see you at that point. So once again, Merry Christmas to you all.